Let's look at three different kind of accounts that most people use for their retirement. My name is Kyle Knott, and I'm not your average finance guy, and we're going to look at those three accounts today. So the first one we got up there is a taxable account. So your taxable account is your savings account, your brokerage account, whatever you already paid taxes on, your paycheck, whatever it is, the money that you've got, you've already paid your taxes on it, and now you're going to take that and you're going to invest it in something. If it's a savings account, and say you got $100,000 in your savings account, it pays 0.5% interest at the end of the year, that would have paid you $500. So you started at 100,000, and you now at the end of the year have 500 more, $100,500. You would have to pay tax on that gain at the end of the year. So that is your taxable account. After tax dollars, you still have to pay tax on the gains. That's a savings account. If you're in a brokerage account and you picked the great stock, you picked Tesla when it was worth zero, and you rode it all the way up to, I don't know, whatever it is now. Or Bitcoin. If you bought Bitcoin super low when you used to have to pay 30,000 Bitcoin to buy a pizza, and now it's worth 100,000 per Bitcoin. So if you bought that with after tax dollars and then you rode that gain all the way up, whatever it is, that gain, that's what you would have to pay taxes on if you had that money inside this taxable account. The second one is your tax deferred account. So your tax deferred account that's like your 401k, your traditional IRA. That's what a lot of people are sold as. This is the end all be all, and this is the greatest thing ever. If you want a retirement, this is what you need to do, because pensions are now gone. So this is what is really pushed and what is really sold the most. Now, that money comes out pre-tax. So say you make $100,000 a year, and your employer will match 6% for whatever of your salary. So what you should do at least that. So say you put your 6% in, so that drops, that which would be $6,000. So then to the IRS, it looks like you only made $94,000 on paper. So you would only pay taxes on, instead of the full 100,000, you would pay on the $94,000. So you're going to pay a little bit less tax, and it's not going to make that much difference, I don't think. But that money goes in, you're not taxed on that money. And then if your employer does that match, so now your 6 just double, that went to 12, and you get into some decent investments. Hopefully it grows over time. Every year, hopefully you put another $12,000 or more into it, plus the growth that you can get throughout the year. It's not going to go up every year. Some years it will go down, but this is the traditional, the traditional IRA, 401k. And with that, it's taxed when you take it out. So this is what most people, I would say, I don't know what the percentages are, but most people, middle-class people in corporate America, probably do this. And at the end, in retirement, now you start pulling a paycheck. Well, since you never paid tax on that going in, now you have to pay tax on that going out. So the more you take out, the higher the tax bracket you're in. So if you really want to have a great retirement and live really high on the hog, just remember that if this is your account, the higher the tax bracket you're in, the more taxes you have to pay. And also, what is it going to be when you retire? Now, if you're retiring next year, you have a pretty good idea of what the taxes are right now, and they're probably not going to be that much different. If you're just starting out and just made your first contribution and you're not going to retire for another 30, 40 plus years, what are the tax rates going to be at that point? Nobody knows. Maybe you get administration in there that really wants to cut taxes. Maybe you get an administration in there that really wants to raise taxes. No one, you can't tell. What if you would go and you buy a house, and what are you going to want to know when you buy a house? Okay, how much are my payments? How much is it going to cost to repay? When do I have to repay it, and how much, right? So what if they say, all right, here's the money, you can go buy a house, you don't have to pay us back for 30 years. It's like, okay, that sounds great. No payments for 30 years, I'll take it. But how much am I going to have to pay you? I was like, well, we don't know yet. We'll tell you in 30 years. What? I don't know about all that. So that's kind of the way the tax deferred accounts are. You don't know what's going to happen in 30 years. You don't know where the tax rates are going to be. You could be, let's say that you're even in the lowest tax bracket, and who knows how much they're actually going to tax you at that point. You surely don't want to be in the highest tax bracket. They'll take all of your money in the first year. So that's one of the things that you just don't know. It's another unknown. I don't like unknowns. I'd rather know where I'm going to be in X amount of time, and that helps me to plan for my future and retirement years. So then you've got your tax-free accounts. So this is after-tax dollars, just like the first one, but this one, it grows tax-free, and it also, you can take the gains. You can take everything out tax-free as well. So these are your Roth IRA, your infinite banking policy loans, like this kind of stuff is where these fall. So I think these are the best accounts ever. Now, this is my personal opinion. Others may think, now if we're talking strictly tax-wise, I think this is probably the way to go, but there's probably an argument for the other ones as well. I just don't understand why you would use a taxable account. And I get it, you can't put a bunch of money into a Roth IRA, that there are caps on that. Okay. An infinite banking policy, if you wanted to go that route, I guess there technically are caps on that too. But if you're going to use a taxable account, you should really look into the infinite banking concept, because there you can put, basically, there are caps on it, but there are a lot higher ceilings than what the Roth is. So if you ever got any questions on that, reach out to me. I'll talk you through it and be happy to help. So with those tax-free accounts, again, you made your money, you paid you got your check, you deposit in the bank, the taxes have already been taken out of it, so it's post-tax, it's after-tax money. Now you take that and you put it into a tax-free account, where here now it can still grow tax-free, just like the middle one, the tax-deferred account. It grows tax-free. It's not being taxed every year like the savings account or the taxable account is at the top. So that growth is tax-free, but then the kicker is, the best part is, when you go to take it out, that is also tax-free. So with the infinite banking policy, if you actually take that money out, yes, it could be subject to taxation, but the way we do it and structure these, we never want to actually take the money out. We just want to borrow against it. And so that's the way that you don't have to pay any tax for any of this, and you can put way more into it than a regular Roth IRA or something like that. So really something to check out and look into. What's your situation? Everyone's situation is so different, and I totally get that. And if you don't have this bottom one, that tax-free account, I would really do a lot more research on that. There's YouTube videos all over the place, or like I said, reach out, give me a call. I'd love to help. All right, I hope this helped, and good luck, everybody.